Tell me that's not the coolest video. I love that video. Good morning and welcome to the Minervini Private Access 2020 Super Performance Workshop. The Master Trader Program is being held day 3 this morning. This will be a day that will include 4 sections with this morning's session. We will take a 5-minute break in between them with a 15-minute break about the halfway mark. The session and the day will last just shy of about 4 hours. And then we will have a replay this evening at 6 p.m. Eastern time again. We'll have the room open about 30 minutes beforehand, 5:30. You are all welcome to come back to that event and encourage that, quite frankly, because this information is a lot and it gets only deeper now with these 2 days ahead of us. And that is the benefit of what the online forum provides for your ability to really get to see this and experience this twice, which is phenomenal, phenomenal. Couple quick comments, one of which is if you do have any audio or video issues, which we've had very little of with Zoom, but you can simply log off, log back on. That has seemingly fixed it virtually every time. I don't think I've had any one person having any kind of real consistent or um, ongoing problems. Also, you do have a backup plan hopefully in place. So if there is any type of issue with you, do utilize that backup plan. And we will provide some information regarding how to ask questions for the Monday trading day. Again, that will start at 8:30 a.m. Eastern time and last right through the closing bell at 4 o'clock p.m. Eastern time. There is no plans for that to be recorded and or replayed. So do bear that in mind. That will just be an all day live event going on. So with that said, let's get started with day 3 of the Master Trader Program with Mark Minervini.
Okay, hello everyone, and we're back here, 2020 Master Trader Program. We're going to start today's session by talking about the primary base. There's actually two scenarios that I want to point out here, and one is what I call a magnitude play, and the other is what I refer to as a velocity play. So the magnitude play is going for the largest gain that you can, and that's the primary base. And the reason is because the primary base is the first viable base after an IPO. So notwithstanding the IPO, it's the earliest that you're going to buy a stock. So if a stock is going to become the next Starbucks or Amazon or Tesla, this is about as early as you can get. The other is the velocity play, and that's the power play. And these are situations where the stock can move very quickly and make a relatively large gain in a very short period of time. So one gives you the big magnitude potential, and the other gives you the velocity potential. We're going to look at both of those, but right now we're going to start off with the primary base. Just to recap some of the things that we already talked about and covered, we went over categories. We talked about valuation and dispelled a few things for you with valuation. We talked about the trend and how you want to make sure that your stocks are in a stage 2 uptrend, because 98% of stocks that made big moves were all in stage 2 uptrend. So again, you don't want to be in the 2% club. You want to be in the 98% club, right? Have those probabilities in your corner. Fundamentals, we went over fundamentals, talked about three things. I looked at them at different angles and different ways to apply them. But what were the three things we talked about? Earnings, sales, and margins. With growth stocks, that's really all you need to look at as far as fundamentals are concerned. But you need to learn how to look at the right things. We went over price and volume. We're going to go over a lot more price and volume. There's still selling. There's still a lot on price and volume. But we covered some entry points. We talked about pivot points. And now we're coming around to the primary base, the first base within the life cycle of a new stock that came public. Also, want to point out that just because a stock comes public doesn't mean it's a new company. It could be a company that's been around. A Krispy Kreme donut, for instance, was around for I don't know how many years, but a lot of years, many decades, 100 years or 80 years, and then they came public. So a lot of times, you have companies that are already proven, and then they actually come public. And then sometimes you have very new technology and then things that, that nobody ever heard of. And that's where I'm going to start this off, looking at Yahoo. Um, Yahoo was a name that I was very interested in back in the 90s and 1997 to be exact. As a matter of fact, right here, I'm going to get my little pointer here, my spotlight. So right on this day, you can see this is where I was buying. I bought that stock coming out of a really just a perfect base. You can see first, big deep base here, but then it tightens up. VCP right here, 1, 2, 3, gets really nice and tight here. You can see the volume comes in, everything we've talked about up to this point. Um, Now you can see the breakout, and then as we spoke about how sometimes you'll get that pullback, and this comes back to the breakout, but you see the tennis ball action, boom, right back into new high ground. So that you wouldn't have been selling on this little bit of pullback here. That's perfectly natural as long as it can get back into new high ground. So again, all the rules that we talked about, they apply here as well with the primary base. This stock went up, of course, about 8,000% in just a couple years. Went on to go up even more than that. But this was a stock that I took to institutions, and nobody wanted to touch it because right here it was trading at 938 times earnings. We covered this in valuation. So again, I wasn't looking at the PE ratio. I was looking at a new technology, and it was the internet at the time. But people didn't, now everybody says, oh, yeah, the internet, of course. But back then, the internet was something that people weren't even sure was going to survive. Let's take a look at another name that at the time, not only was it a name that nobody heard of or very few people heard of, but those on the street that were covering Amazon hated it. Most of the analysts said that Amazon would never make money. It was really a hated stock for a long time. I was buying it right here, coming out of this base. You can see once again, similar to the Yahoo situation, where you get this big decline and it's just a little too deep here. Now it really tightens up. As a matter of fact, you even got, if you take, let me get my little drawing tool here, right over here, you actually got a cheat area right here. So you could have been buying coming out of here. And then, of course, it's set up right here, if you want to call it, you actually got a low cheat, and this what you call this a cheat or a handle. It's in the middle third, so I would call it a cheat area. So you got 2 buy points there.
And in Mark, the other thing that's kind of interesting, you've got a large cup and handle and then a smaller cup and handle. If I could, let's see if I could draw this. You'll see here's left side of the base, bottom of the base, and then here's the right side of the base, and then here's your whole handle. But then within that, you've got another cup and handle forming right in here. So there's your cup and handle within a cup and handle.
Right, and we love to see that. No, that's that fractal setup where we see the patterns within patterns, and that strengthens the patterns. Um, let's take a look here. Hold on, let me just go down. Scroll down here, Starbucks. So now I'm showing you some names here that these are household names. Everybody knows these names. But again, at the time, very few people knew these names. They were, smaller cap, mid cap. You think now Starbucks. Oh yeah, sure. But these companies all started off as smaller and unknown names. Even Walmart at one time, when I was first trading Walmart, it was, I think I said this before, but Sam Walton was standing on a soapbox in front of the stores, flagging people to come into the stores. It was a mid-cap company that was growing very rapidly. Starbucks, if you can see, this is a very tight, this has got percentages next to it, not price, but so you can't really tell, but this is actually a very tight price action, but within it, you still get VCP action right down to that last little tightening where you get just one day going inside. I mean, really just perfect. This stock, of course, went up over 3,000% over the following 11 years from the IPO base. But this is your primary base here. Now, you see it goes IPO here. And, you could say, well, what about this base right here? Well, it's 1, 2, 3, 4, 5, I don't know, maybe 7 days or so. That's really not a base, even though it did work. But 7 days is really a short period of time. I like to see several weeks, 3 weeks, 4 weeks, preferably even more than that. And a good size base. And the other thing too is you want to see the IPO if it's a success. If it's not a success, and we'll look at a few of the ones that kind of bombed first. Facebook, of course, was one of those that didn't do well on the IPO. Those a lot of times take a lot of time, need more time and go through very deep cups. Another one that I bought, and we talked about this earlier, and Dave pointed out how this had a few good characteristics. One being that you shook out this low right here. Also, that right after you shook it out, very quickly, you came right up the right side here, strong. That was on the company raised guidance. And then from there, then you built the right side and you got nice and tight over here. And then it was ready to be bought. And I bought it coming out right here. I mean, really, this is just textbook perfect. It's got everything. Shakeout in the lows, institutional, buying coming up from the bottom of the base, upside guidance, tightening. I mean, everything's just perfect. You get the 1-2 punch here. Everything's just right on this one, and it worked out great. Dave, I want to analyze this Dick's Sporting Goods, and first let me get this stuff out of here and take a look at it over the market. This might look like a lot of information, but you certainly can make heads or tails of it. A few things, we talked about how it shook out the low, of course, and it tightened up, but I overlaid the market here and to show how, and also you might want to talk about, Dave, on how, when the market is in, bottoms and starts a new bull market, that's when some of the better IPOs come out, right?
Yeah, it's yeah, you have to be careful when there are a lot of IPOs coming out and they keep on going back to the same group for IPOs, and the market's been moving on for a long time, because after a bull market's been going for a year and a half, the investment bankers are almost running out of ideas or running out of new companies that they can take as an IPO. So, and lots of times they come out at very high valuations and everybody's getting excited, but the best IPOs come out, in a bad market, and they don't get a huge premium and no one's that excited about IPOs when the market's in a bear market. But those are the ones you really want to be concentrating on. And as you see in Dick's Sporting Goods here, this, we're right
before your pointer again. I need your
well,
pointer.
I'm actually not pointing, but this I think is very, very important when you have a relative strength new high. See, the market is in a downtrend, and Dick's is actually just going sideways, but that means it's acting better. It's acting relative to the market. It's holding its own, and it's outperforming the market. And so when you get a relative strength new high, and the stock is starting to set up, that's a big clue that this might break out right when the market starts turning up, and that's exactly what it did.
Yeah, and again, one of the screens that I often run when we're in a correction or a bear market is I look at relative strength lines hitting new highs. MarketSmith has it where you can just check a box and it'll give you the stocks that have relative strength lines going to new high ground. And so this would come up on that, and you would see this coming coming into this handle phase, this tightening phase, where this classic VCP action. And again, the high relative strength stocks, in particular, when you're in a correction, that's when you really want to start looking at relative strength, because these are stocks that they can build up a high relative strength and they actually be going down, but less than the market. So it's relative strength. The other thing too, and as Dave pointed out with the IPOs coming to market, the stock market is a business. And when things are good and the stock market's ripping to new highs, they can start selling just about anything, right? Because everybody's seen all kinds of great stocks move up. And so now, the more questionable merchandise can be pushed at higher valuations. And that's what Dave was talking about. But again, when the market's in a correction, I'm looking for IPO bases. I mean, these are the magnitude plays. Again, this is your first chance to buy this stock after it goes IPO out of the first base. So it's the earliest that you're going to get the stock. If it's going to become a big giant winner, you're in about as early as you can get in.
Yeah, and Mark, the other thing that I want to mention, I've said this in the past, is that sometimes I sit back and I let the market tell me, show me what are the strongest stocks in the market. And I just look at those stocks that have doubled in price, and I look for their next base to form, and I get that next double if I missed it. So here in Dick's Sporting Goods, in this example, the stock went from, went from 3 to 5. It almost doubled in price, built a whole new base, and then started off on another run. So let the market show you what are the best stocks, and then get them on their second move.
Right. Two things. One, keep in mind that, like I said before, these are all split adjusted prices. It wasn't really a $3 stock. David and I don't buy $3 stocks. However, so that's split adjusted. The stock was trading much, much higher. But to Dave's point, I'm looking usually for a stock to be up 100 to 300% or more before I'm even interested in it. And that might sound strange, but when you look at the biggest winning stocks, I think the average move before, if my memory serves me, the average move before a stock became one of the biggest winners was about 360%. That was the average. So you're looking for stocks that are already showing you strength. So I'm just going to go through. We're going to go through some IPO bases here and show you the characteristics and just map it out. Again, just like I said before, it doesn't matter whether it's a IPO base or regardless, I'm always looking for VCP action. And you'll see every one of these examples has VCP tightening on the right side and classic price action, as we pointed out before. So you see here, you go through this large base, but then, if we were looking at it over here and we're flipping through the charts, Dave's not even going to stop to look at this over here. But over here, yeah, anywhere in here, you're going to start saying, okay, this is starting to tighten up on the right side. And now right here, wow, it gets really nice and tight. And that's where, of course, that's giving your, potential green light. And as soon as it gets above the pivot, I'm buying right there. This stock goes up 450% in just a couple of years. Those are the type of moves for magnitude plays that you want to look for. Now with Borland, this was, of course, in the 1990s. This was a leader in the 91 bull market. Look how tight. I mean, this is incredibly. You went tight for 1, 2, 3, days here. Just perfect action. Now it breaks out. I'm buying it as it comes out here. I bought it actually on the second day. It first started turning up here, and I just wanted to see it just get out clean above this high over here, this reversal. It got out. I bought it. Followed through for a day. Now pulls back here, and like I said, this is perfectly natural to pull back to the breakout. But look at the tennis ball action, right? Bang, right back in. So it takes 1, 2, 3, 4, 5, 6 days to pull back, and then boom, just 2 days, it's back in new high ground. That's the type of action you want to see, the tennis ball action. And again, just like the breakout comes up on volume, same thing here. We pull back on lighter volume, right? And then the volume comes in on the breakout and on the follow through. So just classic action with great volume characteristics. Let's see here. So Farmion, again, these can shape up in various different ways after an IPO, but you'll see over and over, looking for that VCP on the right side, trading up around the old highs here. I mean, this is just really another just classic, comes off, it's pretty deep base. You're coming off around 14.5 down to $11. So pretty good 40% or so decline. Comes up. I'm not interested in it until it tightens up on the right side. Then comes out here. This stock went up 270% in just 6 months. I didn't get that whole move, but I got a nice quick move out of it there and made some good.
Now, Mark, all these examples that you're showing are IPOs that have been trading for, it looks like 6 to 9 months. But you can. But aren't some of the biggest winners found in general in IPOs? But the IPOs that have been out for 3 to 5 years too, isn't that you don't have to find only ones that are 6 months, but you can lengthen the time period too.
So the statistics are that 80% of the biggest winning stocks going back a long time, looking back 60, 70, 80 years of stock market data, 80% of them were new IPOs within the previous 8 to 10 years. So that's still a relatively new company. I mean, a company that's only been around for 8 years is not an IBM or a GE. It's still relatively new. And I think that's Dave's point, is that, we're looking at some of these that are, 3 or 6 months or whatever, but, you certainly, they can have histories a lot longer. But these are, we're looking at the primary base being the very first base after the IPO. And sometimes, you might have a stock that's been around for, 5 years and it's already gone through that primary base, but it's gone through some corrections, maybe a bear market, and now it's coming out of a new base and a new uptrend. L3 Communications, another one, you can see made a really big gain from here in a relatively short period of time. Again, you see the tightness on the right side. I mean, really just gets really nice and tight there, and comes out real strong too. Look at the breakout, really, really strong. Let's look at another one. So this was Voya. This was in 2013. Again, look at the tightness on the right side. And this is a classic just cup with handle. I'll just get the drawing tool out here. This comes down this left side, up the right side, right? And then forms your little handle there. But you see, again, VCP are characteristics within the pattern. So the characteristic of volatility contraction, that's what you're looking for on this right side. Nice and tight on the right side. And then you get the breakout. And again, like Borland, spends a few days, doesn't follow through right away, but then gets right back into new high ground pretty quickly. This didn't make a huge move, 71% in 23 months, but a pretty nice gain. And
But the interesting thing is that the examples that you're showing is that they're from all different industries. It doesn't have to just be high tech. You've got retailers in there, financial stocks. You've got them from all sorts of different groups.
Absolutely. IPOs are going to come from all different groups. And that's one of the things that you don't want to do is start favoring certain industries. I mean, I did point out earlier that the cyclicals are something that I do shy away from. But if there's a lot of cyclical stocks setting up, I'm probably going to play them. I mean, if I'm seeing a wave and I'm seeing a lot of names setting up, I'll probably play them. But I might play them a little bit differently. I might trade them, a little more instead of trying to hold them for a bigger move. It depends. But bottom line is, like I pointed out earlier, there's some groups that really are the growth groups. The papers, the steels, companies like that are really deep cyclical, have an inverse cycle, but they can set up too. As a matter of fact, I have a few of those we're going to show you. Shake Shack. This right here, why I didn't buy it here, I have no clue, because I remember I was watching it and I did not buy it for whatever reason. I can't remember. But this is one that I did not buy at this particular point. I did buy it later, and I'm going to show you that in just a second. But this is just, I mean, classic. Look how it tightens, beautifully tightens. Volume comes in. It's kind of skewed here because of this big giant bar here. But it comes in, and you can see the volume comes in on the breakout, and just look at the breakout and then a follow through, just big follow through day. It pulls in midday and then closes. And then look at the natural reactions. I mean, 86% in just 30 days. Nice move, very efficient. I didn't buy that, but I did buy it later here. So we got, just like I said, you might get another base, forming later on. This was the previous base was the IPO base, but now we got this next stage, second stage base, just formed a classic coupled handle. You actually had a cheat area right down here. I was watching it and was thinking about buying it down here, and I did not. It came out just a little bit higher, and then I decided to pull the trigger here. It moved up. And I believe I held into earnings. That's what this big gap was, because I had a little cushion on it and then had a nice gap on the earnings. Sold into the strength. But this, again, 60% in 40 days. So not, this huge big winner over years and years and years. However, 60, 70, 80% in a month or two can really add to your portfolio pretty quickly. Alibaba. So this is a weekly chart. And you can see that you got a big, volatility contraction right here on the weekly, and some tightness on the right side. But at that point, you're not in a stage 2 uptrend yet. But you do get in a stage 2 uptrend, right? Actually, I got an arrow tool too. Okay, that's good. Right here. And now, once you're in that confirmed stage 2 uptrend, then you start looking for that base, and you form a nice classic coupled handle. Just straightforward coupled handle in an uptrend, comes out right here and off to the races, 94% in 10 months. I'm not sure what it did subsequent to that, but a nice initial move here. Let's see what else. So here, Dave, here's one that's close to your heart. We were both buying this on the same day. As a matter of fact, when Dave came to Myrtle Beach for the Master Trader program, the year that we were looking at this stock, we went to Ollie's.
Oh yeah.
Yeah.
That's one of my favorite things to do when I find a stock that, especially if I'm traveling and it's this store is not even close to California yet. It's still doing fairly well. It's a it's a regional story that's now going national. And but at that this was in 2016, and it was my chance to go and visit one. So it was fun to go and see what it was actually like.
I remember calling you and you said, I'm going to go over and there's an Ollie's not far. I'm going to come in the hotel. And he was going to Ollie's. And then I called him later on, and I think I was calling him to have lunch or dinner or something. And I said, what are you doing? He goes, oh, I'm at Tractor Supply. I remember you went to Tractor Supply. Yeah. So and he found another company that was a public company that he was looking at. That's
what's so much fun about retailers is you can walk in, you can see it, you can feel it, you can see how they're doing. But it's also important to go to more than one, because sometimes you can go into one store and it's not busy at that time, or it's just not the greatest location, and you might get a negative vibe from it.
I don't remember the year, Dave, but there was I remember I was in New York, and something was buzzing around Wall Street that you and Bill O'Neill were seen eating in a cheesecake factory. And then all of a sudden everybody was like, oh, they're checking out Cheesecake Factory. I don't even know if I ever told you that.
I don't know if I remember that.
You guys were spotted in Cheesecake Factory eating together, and people were saying that you were scouting Cheesecake Factory. Okay. Anyway, so Dave and I were buying this on the same day. I actually bought a little bit earlier right here. I'll show you as it came through right here, this little load sheet in the handle, if you will. On this day right there, I started buying at half my position, and then it just set up classic perfect right through here. And then I added to it here, and Dave initiated his position right there. So we were actually buying on the same day. I had traded this name several times. I actually didn't make a whole lot of money in it, back and forth in it. But Dave did really well because he held it. You see, it went up 330% in 30 months. Take a look here. We looked at this earlier. On the weekly, it looks beautiful too. I mean, it's perfect, comes out just right. And it just formed base after base. I mean, you stayed with this for quite a while, right, Dave?
Yeah, throughout. Yeah, I was at least I had, sometimes I would trade up into my position or increase my position, go back to a core position. But I was with this stock, throughout this entire move.
So you got the primary base here. You got another base that built right here. You see tightness on the right side. You got another base that built right here.
Yeah.
Now they're getting a little sloppier here, but you did have another base here, and maybe you can even count this over here as a base. So you got a bunch of chances to trade this, and sometimes you can trade in and out around your position or add to your position. So that one worked out quite nicely. Now this one here, this is funny because it was around, you can see it's in December, or it's starting to set up here, and it was just before Christmas that I was in a mall with my wife and just happened to see this store. And I don't know nothing about when you start getting into women's clothing. And matter of fact, if I like it, it probably will fail because I'm the anti-average Joe. Anything that I like usually doesn't last. But I thought that the merchandise was really quite unique, and my wife thought that it would be good for young people. Anyway, it was Body Central, so I immediately went and took a look, and it was a stock that was trading, and it was setting up. Lo and behold, it was setting up almost perfectly right here. You can see right going into Christmas, into the new year. You set up that little right side here, and then it broke out, and I bought it, and then I sold it right into this rally right here. And then, of course, it went even higher, but I got a nice quick move out of it. But that was an IPO that I also found, like kind of like Dave doing the on the ground research, if you will, in the mall. Michael's, my daughter and my wife used to go to Michael's quite a bit, and I heard that they were going public. And this setup, again, see a little sloppy here on the IPO. See, it first goes IPO here, and right here, let me show you. This is, right here, if this stayed sideways and came out, you might have been buying it, or I might have been buying it right here. That would be enough. That would be enough action. 1, 2, you're looking at about maybe 3. It would have been about 4 weeks setting up, but it did not. And like we said, you want to wait for the stock to set the pivot, tighten on the right side, and then break out. Instead, it broke down, and then it came down now, ran up the right side. And as Dave pointed out earlier, you got to be careful with wedging price action. This just wedges up the right side, still not ready. But now it starts to tighten up and move sideways. That's pretty nice. Comes up the right side, and now the VCP starts, right? And you get right here, it tightens, and now it comes out perfectly right above. Right here's the pivot point, and that's where you start buying. And that's where I started buying. Again, 60% in 4 months, not a big giant magnitude play, but a nice initial rip coming out of there. Now here's a cyclical, Phillips. And again, this is really, I did not buy this, and this was another one that I was watching at the time, and who knows, maybe I stayed away from it because I often stay away from the oils and the commodity plays and so forth, and the steels and the papers. Don't remember why I didn't play it, but it was really set up quite perfect. You can see here let me just get my pointer right here, very tight, and it goes through a long process. We're looking at 1, 2, 3, 4, 5 months, 5.5 months, and then look at the breakout. See, this is what we talked about earlier, where you want to see that nice breakout comes out day 1, day 2, pulls in a little bit, has a good close, 3, 4, 5. So out of 1, 2, 3, 4, 5 days, you've got 4 out of 5 up, almost 5 out of 5. And look, every day is a good close. See, so that's a very, very good breakout. So Dave, if you bought this and you saw these 5 days like this, are you selling into this? Or
No,
is
no.
this something telling you to hold
Yeah,
for?
it's telling me that, hey, you've got a lot of company on this trade. There's a lot of other people who want to get their position in it, and so this is probably going to go well. I mean, you can see what on the top of the page how far it went in 6 months, but that's usually telling you there's some big money in buying this stock.
Yeah, and I want to go through, at least give it a chance now to go through a pullback and see if it goes through a natural reaction, if I get that tennis ball action, and then that would tell me to hold it even a little longer and maybe try to go through another natural reaction. Now, just taking a look at this on a weekly and putting it into perspective, I want to just show you the right place to be in the stock, and then where the stock starts getting sloppy and a faulty base. So this is a great base. It's a nice IPO base, comes out, makes a nice move here, and then you see that correction is pretty deep here. Now you're getting a really deep correction and more wide and loose behavior, and you're starting to flatten out on the moving average. This is getting into a stage 3, and then you break down, you're in a stage 4 now. So this just shows you the whole maturation cycle and how it can take place in a few years. It can take place over 5 years or 10 years. It really depends. As long as it's in a stage 2 uptrend, though, you could be looking to trade those bases. But when it starts going into stage 3 and then, of course, stage 4, then, of course, you want to stay away from it at that point, just to put that into perspective. So I talked about Facebook, and LinkedIn was another one that came out as an IPO and just immediately failed, went into very volatile price action. I had not gone near the stock until way over here on the right side. And again, just showing the patience to be able to wait it out. And you can see big earnings and sales. This takes it all the way to where it is up here on the chart. But prior to that, you can see big earnings and sales. And again, take a look at how this is just, wow, what a huge decline. So now it comes up the right side. This is just way too wide. You say, well, why didn't you buy coming out here? Because this is not a proper coupled handle. It's just too wide. Handle, I don't even know what the percentage is here. It looks like 20% or so. A handle can't be 20%. That's a base. You would need tightening within that. But now, as it gets real tight on that right side, and preferably it's tightening up right at the old highs. You see, and now as we break out of there, we get into new high ground. As we pointed out earlier, that's where all the excitement starts. So all the excitement starts in new high ground, and that's where I'm buying just as we come out of the base there, and then it just takes off. I remember they came out with earnings, and they piled into that stock.
Yeah.
Now, as we've pointed out many times, you can get multiple buy points. Sometimes you'll get an IPO base and you'll get a good trade right off the hop, and it'll either reset and give you a chance to buy more at a higher price with an additional setup, or if you missed it, you might be able to get another chance at buying it. A lot of times I trade around positions. In this particular situation, Pega, this was back in the 90s. You see it came out of an IPO base here. I bought it. I sold it right into this. It made a nice quick rip. You can see moving up from 13 or so dollars up to 19. So a nice quick move. I actually sold out of it, and then it reset. And then, a month or so later, I was right back in it coming out here. And what a breakout. I mean, look how tight. Just went flatlined, and then bang, comes out of there. And that's the key. When you get that really tight price action, the volume comes in, you're setting up for an explosive price move, because there's no supply. It's telling you that there's no supply, and even a small amount of buying can move the stock.
Yeah, and Mark, I would just add for those people who don't trade in and out, or don't trade around the core position, that second buy point where you're buying here, if you had already bought here and you just stayed with your whole position, at the second buy point, it's almost a brand new situation. You could actually even double your position. That's where I've seen O'Neill make a lot of money, where he gets on aboard one stock and he just keeps on buying that every base on the way up, because he knows it so well and he has so much confidence in the company and in its fundamentals. So this is where you can really get some big gains if you keep on buying some, adding money to your most successful stocks.
Yeah, and that really, that also goes back to the fundamentals, where if you're going to pyramid buy like that and start building a position and buying higher each time there's a base at higher prices, and really going for that big move, that's where you do want to see the fundamentals. You want to see the earnings, the sales, because profit margins improvement, with negative earnings or even positive earnings, but sales that aren't up very much, that are due to profit margin improvement, that can't last very long. And I think I asked you this before, Dave, but did you ever see O'Neill ever pyramid buy and load into these stocks like this, that companies that were losing money or showing negative earnings and sales?
No. He was always going with some of the strongest stocks on a price basis, but then also on a fundamental basis.
That's right. Now, if you're short-term trading, in your swing trading, you're taking 10%, 12, 15% moves, you can be straight technicals. Now, it's great to have the fundamentals too, but almost every stock moves up 10, 15% at some point. So again, if you're short-term trading, you can lean more to the technicals. So this is just another looking at ASND, showing multiple buy points. Again, but all having nice tight right sides. Right side here, look how nice and tight there, and then it really tightens up quite nicely right here and comes out. Another one, this is Shopify. Again, you got a cheat area over here. This is maybe a little bit sloppy on that right side. I wouldn't be interested in it right here. But then right here, it's coming out of a nice tight price action. And again, now you've eliminated the supply. You're going into new high ground. It's an all-time high ground at this point. But just looking at another IPO. And again, to wrap this up, taking a look here at Burlington. And now I remember, Dave, this is one that you were in. I can't remember if we got it. This is where we were buying it. I think you were buying it here too. I remember you called me up and I forget your pitch, but it was something about it was going to be a cold winter and people were going to buy coats.
Yeah.
I can't remember, but you alerted me to Burlington at the time, and I had bought it. This is back in 2013, I think 2014, and again, you see, look at all these reversals. So I told you always look to the left for traffic, right? Um, and you've got all these reversals, but then it tightens up right at that point, and you come out of the tight area and eliminate all those highs. So you clear that area where you're having consistent issues with. You clear that coming out of a tight area, and this is 1, 2, 3, 4, 5T. Tightens up on the right side beautifully. You even had right at the last moment there, you had just a 1 day. You see where it just tightened, if you can see that. And you get that, what I call a pause pivot. Comes out, follows through 1 day, pulls back 2 days, but then wham, rips right back into new high ground. Tennis ball action. Look at these pullbacks, how it just gets right back in new high ground. Even here, it pulls back, but has a good close and then right back into new high ground. And this is just classic natural reaction, tennis ball action over and over. This went up 430% in the subsequent 4 years. I did not make that big of a gain on it. I just traded it, but it came out of a perfect base. You recall this one, Dave?
Yeah. Oh, yeah. The problem I had with this one is when I went into a Burlington stores, because they had them out in California, I actually didn't like the merchandise. But you have to be careful to separate what your tastes are with the tastes of other people, because people have all sorts of different tastes. Because I didn't like it, I don't think I stayed with it as long as I should have. But that's where you have to really just concentrate on what the market's telling you, what the stock is telling you, what the earnings are telling you, if you should stay in the stock. And don't get so caught up in the emotions of either you like the store or you like the clothes or not. So you got to be careful there.
Yeah, yeah. I tried that Peter Lynch approach for a while, where where you go and if you like the product. I found that I have to do just the opposite. When I hate the product, I usually should buy the stock, because, like I said before, I'm not a really good judge of what maybe the 13 or whatever the age group is, 12 to 18 or 25-year-olds, and in particular, even what maybe people my age would like, because I just don't have the average taste, and I've realized that I'm wrong many times on uh, business models that don't make any sense to me. But then I look at the stock, and the stock's setting up perfectly. It's got the earnings and sales, they're delivering the goods. So I buy it. I just buy it. And as a matter of fact, I actually feel comfort now when I don't like the product. I've been wrong so many times.
Yeah, well, I think for the average person, I think they should be somewhat in the ballpark of buying the best product at the best price, or shopping at the right store, going into going into the more successful restaurants. And so, but if you can combine that with what you're seeing and it's all positive on the chart with the fundamentals, usually you're going to be fairly successful. I get very upset when I actually use a product or buy the product, and for some reason I'm not in the stock and it makes this huge move. That's where I really kick myself.
Yeah, then it was like right in front of your face.
Oh gosh. I mean, I you kind of go, I mean, I've been using an iPhone since it came out. Why don't I still have Apple?
Apple, yeah, Apple, Amazon. I mean, these are Netflix. These are things that are right in our face, and and the writings was on the wall for a long time. Okay, so we went over these IPOs. I think you got a really good idea on how we trade the IPO base, the primary base, and how we apply the same exact VCP concept to the technical analysis. And looking at, these are models for you to have and to compare stocks going forward. And then you should be making your own model books. I have as I pointed out before, something like 20 something thousand pages of models in my model book now, just volumes and volumes and volumes that I've built by hand, just charts, and put them in there and had them bound. And I've got all these model books now, and I started doing that back in the 80s and been doing it ever since. So, after a while, you're going to get all these precedents in your head. You'll start, going, hey, that one, yeah, this one looks kind of like Burlington back in 2013. You'll start to have sort of that Rolodex of precedents in your head. But you got to look at a lot of charts, and you got to study these things carefully and plot over them. You know what we're talking about. Look at the price and volume action and the earnings. Everything that we talked about up to this point applies to the primary base and the new IPO stocks. We're going to take a break, and I promised you, or I told you, that we're going to talk about magnitude and velocity plays. So we talked about magnitude being the primary base, the earliest that you can get on a stock at the first base after an IPO. Now we're going to talk about velocity, and that's going to be the power play. When we come back, we'll talk about the power play, but we'll take a break right now.
Okay, guys, that is the first section conclusion. I forgot to mention it was page 245, primary base, and a really exciting section because so many of you do like to play IPOs. We're going to take a 5-minute break right now before we start the next section, which is the power play on page 270. This is actually my personal favorite strategy or setup. I'm sure you'll like it too if you're not familiar with it. So in 5 minutes, we'll be back. Get up, do your 10 jumping jacks, get the blood pumping, get some food, get a snack, go to the bathroom, get a drink, whatever you might need to do. But we're just getting into the day. So we'll be back in 5 minutes.